All right. Welcome, everyone. Thank you for joining us tonight. It's Thursday, 7 p.m. Eastern. Another edition of Real Estate Accredited, our real estate virtual meetup that we have every Thursday at 7 p.m. Here to share a little bit of knowledge, make it interactive. And this evening, my co-hosts are tied up with other projects, so it's only me. And my name is Philippe Scholegen. I'm with Boost Capital Group, and we are doing mostly in-place multifamily value-add investments. So today we are going to talk about unlocking your wealth in 2024, and more specifically, how you can build wealth through multifamily real estate. We added a disclosure recently. We do not provide tax or legal advice, and all the material provided is for informational purposes only, and nothing should be construed as an investment advice or an offer or solicitation to buy or sell securities. With that out of the way, building wealth through multifamily real estate in 2024. And first, I will start with a little bit of a refresher or reminder of what we discussed in a few past calls. And I put here in orange sometimes what we hear from investors. And you come to them with an opportunity, a deal to invest in, and they say, the economy is bad, I don't want to invest. To answer that question, and I think a good way to answer is particularly with regards to multifamily real estate as an investment. There are three particular items that are worth mentioning. Number one, multifamily or real estate in general, or let's say housing, is a basic need. Shelter is a basic need that everybody is going to look for and need that. And in case of downturn in the economy or pandemic, like we had a few years ago, a lot of the real estate suffered and some of it still suffer. Housing in general, multifamily in particular, compared to other asset classes in real estate, continue to do well. The second item on this page, something that has been going on for decades now. As you can see, some numbers since 2012, there was 1.65 million housing units missing. We've reached in 2021 about 4 million housing units. So there's been a chronic housing shortage for a number of reasons. It's not the point of this meeting to discuss that, but it's been going on for a long time. Finally, based on current economic environment, interest rates, there's a very large affordability gap between renting. At the bottom right here, you can see the orange line is renting, the blue line is owning a home. I've seen, when I was researching, preparing for this, I've seen some charts where the actual cost of owning a house went a little bit below after the 2008-2009 housing single-family crisis. All the charts agree to say that there's a big gap between renting and owning a home. So that's why we love multifamily as an asset class, for all these reasons. Number two question that comes often from investors, it's not the right time to invest. Right? Why investing now? It's like everything is so bad out there, the outlook, etc. It happens that we are technically at a market bottom. And here I'm showing the market cap rate. Definition of the cap rate is here on the right. Value. The value of an asset is equals the net operating income divided by the cap rate. So that's the formula used in commercial real estate in general. So if you have a constant net operating income, increasing cap rates mean that the values are down technically. And so you see in 2024, maybe 2025, economists are forecasting really the actual peak of the market, but you are very close to the peak. And technically, I'd say since the Fed announced that they would decrease rates, and actually they just had the meeting yesterday, I believe, and they announced that Jerome Powell announced that he will not increase rates, and they are still looking at decreasing rates. So we're probably currently at the market bottom in terms of prices because there is a relationship between the interest rates and the valuations and cap rates. You can afford to pay more when interest rates are lower. That's the reason. So we are currently at a market bottoms. Our point of view is that it's a good time to invest now. By the way, I'm providing here at the bottom links to the videos where we discuss these different topics a little more in depth. I can put it in the chat. If you visit our channel, do me a favor, subscribe. You can subscribe. That would be fantastic. We're trying to grow our audience. It's going up slowly. All right, next. That was our discussion last week, how to underwrite multifamily real estate like a pro. And in that context, what you often, I just heard that exact comment 2 days ago. I had coffee with an investor, but interest rates are too high right now. It's not the good time. You cannot find good deals, right? The reality is that you're going to build a model, an underwriting based on multiple sources, and you're going to take it into account, sure enough, debt terms. It's before the last here on this list, and you're going to collect various data points from various sources, and that's how you can come to building a model. And then when the model works, then you can submit an offer. If it doesn't work, then you don't. I'm not saying it's easy to find deals. It's just a matter of doing the underwriting and see which deal works at which price. So here, that's something new, this table, but a couple of weeks ago, or maybe a month ago, we spoke about our vetting process. And in other words, like how to increase your odds of success, how to vet a sponsor, the market, the asset, the business plan, target returns, what to look for. Again, I'll paste the link to the video. You can subscribe in the chat. I guess I'll put the links in the description for the recording. So what's new, and that's something I developed recently while talking about that with a student, actually, was last week. And I was telling him about these different criteria that we evaluate, like when we look at a sponsor, how much experience do they have, how many full cycle deals they've done, how focused they are on a given market, are they vertically integrated? Just to give an example more in details about the sponsor, we have similar topics or similar details about all the different points here for sponsor, market, asset, business plan, and target returns. It was an interesting exercise to look at the rear view mirror and try to grade for these 5 items all the deals that we've done. And since I began in multifamily real estate in 2017 to more recently in 2022, we started our Boost Wealth Fund. So that's all the 5 last deals that we have in dark blue. And if we put some numbers and basically the numbers, they go from 3 being, say, average or neutral. 1 would be poor, 5 would be excellent. So you can see how progressively we fine-tuned and increased our criteria for all the different topics here: sponsor, market, asset, business plan, target return. So if I take, for instance, the market, initially we had a few deals in, I would say, looking in the rearview mirror, like subpar markets. Sometimes they were a little bit better than average, and a number of deals that were in markets that were not ideal, especially with the filters that we use now. And we improved our criteria. We redefined our goals and didn't accept to make exceptions, particularly. So now we are more in a 4-5 kind of range, going from a lot of twos here at the beginning of my real estate career. The assets themselves, nothing pretty constant there. The business plan, I would argue, probably okay in most of the cases. Better now because especially now we're looking for reserves, and that's why we need reserves, significant reserves to have a 5. Still a work in progress on all these numbers, but just to give you an idea. All the target returns, they are in line with what we do usually, and I put the specifics here, like the equity multiple is between 1.9x and 2x in 5 or 6 years, so which is very typical for the industry. But now there's only so much you can do in terms of filtering. But the reality is you have a number of, let's say, external factors and the economic environment as a whole. And for instance, external factors, we had fires in some buildings, we had gunshot on a couple of properties, which arguably you could say maybe if you go with a class A property, you're going to avoid that. But we had, yeah, I think we had somebody actually was killed on one of our property. And the economic environment, obviously COVID took a hit on some of these properties, and also the increase of interest rates more recently. And you can see what's interesting. So different, I did the total of all the factors that we can filter up front. And as you can see, we're improving through time. We're having better filters. The target returns, they're still the same. Whole period still the same. Economic environment, as for right now, we're still, there was nothing particular, let's say, since we started the fund. But in terms of performance, you can see that before we had all these filters, we're kind of all over the place. Sometimes we are a little bit below, sometimes way better, sometimes again below, a little better, below, much worse. And right now, since we started, we're much more stable, which is certainly what we look for, stability. However, I'd say we're not, who knows can happen with the economy or other external factors. So with that in mind, my next, and it's a little bit different from what we've done usually, and I'm going to pull up my spreadsheet, and just give me 1 second to make it big enough so you can see. I was working on that today. Let me zoom in. I can explain to you what we're looking at. Maybe, yeah. Okay. Bigger. Okay. All right. And actually, yeah, let me have to make it slightly smaller. Okay, so you can see everything. All right. So you see I have a little button here. You can have fun. I have to, I'll share it eventually. I'll put a link probably with the video. But let me explain what we're looking at. So this spreadsheet is just an illustration of, based on all these things that we discussed, and particularly the table I showed earlier, and showing that at the end of the day, maybe you'll have a lot of deals that are going to do the 2x equity multiple, but there are also a number of deals that may do better or worse, right? So that's why I'm not only showing a 2x throughout for all the deals. I have introduced here a wild card, right? And with the basis that 2x is the average equity multiple in deals in general over a period of 5 years, right? Five years average hold. But my wild card, the returns can vary from 0 to 3x. And every 4 deal, I have the wild card. And here I have a little button that you can click and see how it will affect your returns. Right, so it varies from 0, this one is 3, 3, 0, 2, 3, 1, 2, right? So your starting point, you have 100,000 to invest, and you're going to invest for the first round, particularly, you're going to invest 25,000 by 25,000, so in 4 deals. Your average is 2x equity multiple. That's what I mentioned. The beyond the first round of investment is going to be a minimum of 50,000 that you're going to put in each deal. You're going to invest in 10 deals maximum at any given time. Average hold period is 5 years. That's the wild card, 0x to 3x. And the total invested at any given time is 500,000. So I'll explain the first line. We spend a little time so you can understand how this chart works. So round 1 of investment, you're going to enter, it's like year 0 when you start. Last year is going to be year 5. It's going to be tied to this average hold period. If I go to 6, it's going to change all the number of years here. I'll go back to 5, which is more typical. And I've seen you can put 4 because sometimes you plan on 4 and the average is, you plan on 5, the average is 4. You can have a blast with that. You're going to take 100,000 divided by 25. So you're going to go in 4 deals. You have 100,000 invested. So your total at that stage, you're starting, you have 100,000. After 5 years, when you're out of the deal, this one has done a 2x, this one 2x, this one 2x, so a 50, 50, 50. This one is only a 1x, a wild card with a random 0 to 3x. So you end up with 175,000. Here, it's just because in the next round, you're going to invest, against a spreadsheet, but by 50,000 at a time. So you're going to put 25,000 at the bank, and you move it to the bank. So at the bank, you have 25,000. Your total at the end, obviously, is still 50 plus 25, 175. So far, you've done a 1.8x equity multiple. You put 100, you have 175 out, which represents an average annual return of 15%. So that's over 5 years. Second round, you invest 150,000, right? And because here because we're investing by 50,000 pieces, I have the 25 that went to the bank earlier. All of them, all the 3 deals, they do 2x. I have 100,000 for each deal. Exit, I'm at 300,000. Still have 25 at the bank. Total 325. So after 10 years, you've done a 3x so far on your initial investment, which represents 23% average annual return. That's because basically you're going to compound your returns by leaving the money in the invested. Though you'll see, and I'm going to continue. Third round, at year 10, you're going to invest 300,000 in 6 deals. One of them is impacted by a wild card, right? So you do 1x only. So you get out 550,000. You've reached your 500,000 max that you want to invest. You're willing to invest. The 50K, they go to the bank, added to the 25 earlier. So you have 575,000 so far. So at year 15, you've done 6x on your initial investment or 32% average annual return. Round 4, because your max investment is 500,000, your total invested. By the way, let me just check something. Yeah, I think I didn't make it. I'll try to make it a parameter too. Sorry. Or you're deploying 500,000. So again, you had 550 from all these prior deals in round 3. Your max is 500. You put 50 in the bank, 75 the bank, total 575, right? So that's what I said. But you're deploying 500 at that point, which is 50K per deal, right? So you're in 10 deals, 50K in. Most of them are 2x, but again, you have wild cards. In that case, you have a 0x. It goes to bankruptcy, you lose your money. This one is doing just a 1x. They're just returning your money. There's no returns. But the other deals are doing well. And because, again, that's something I could have mentioned too, you're diversifying your portfolio in different deals. So don't put all your money in the same basket. Because if you're lucky, you're going to do 3x. But if you're not, you could do 0. That's the idea of this chart. But at that point, you have 500 in, 850,000 out based on the two wildcards, like I mentioned. You're $350,000 beyond your 500 investment. So you put that at the bank. So to date, you're at 925, 9x on your initial investment, or 41% per year. Year 5, same thing. You are doing the same. So I'll skip math here and just say like at the end, you come out with 850 again, 350 to the bank. You're at 1 point almost $3 million. 13x your initial investment. 30 years, you end up at about $1.8 million. And that's my baseline. Now we can play a little bit. Obviously, you can start with more. I'd say average equity multiple, I would leave it alone. I know I played earlier with the max investment per deal. Let's say you go to 75 now, right? Which makes it, because you're in 10 deals, your total invested max is 750. Now you are at $2.3 million at the end. If I click, I do more like randomized wild card. You can see how it varies. It goes between $2 and $3 million. It's interesting to see the different numbers. But obviously, if you put, say, 200,000 in the initial investment, that's where you see the numbers. They go much higher. We can say I put 50 per deal, first round, 100, max $1 million. And like you can see how you can increase your wealth. And for some of us, like me, who doesn't necessarily want to wait 30 years, or doesn't have necessarily 30 years of life expectancy left, we can use an intermediate round as an exit for illustration. And again, the year hold mean period with you're more looking at 4 years, really average. Right? I like to use the nominal. If you go to 4 years, your sixth round is going to be after 24 years. So it'll be 75 by then. Can I survive at that point with 4.4? Yeah, probably. Yeah, there's inflation for sure, but it's under control. Any questions on this? I know it's a rich, complex chart. Hopefully, I was able to explain it and it made sense.
I would love a copy of that.
If you ask nicely.
If
you like and subscribe to my channel.
I did. I was trying to do that earlier when you say, just by the way. I give you the thumbs up.
So I will only give this to people who like and subscribe to the channel and leave
Right.
a comment in the.
I will. Make sure you put it up in
you.
YouTube, and then I will. Promise.
Yeah, I want to tweak it a little more, but I'll share it with you.
I like it. It's pretty good. Pretty cool.
I think it's an interesting and as in my opinion as realistic as possible, because you're still going, even though I know we improved our kind of our bar and our filters and this and that, but at the end of the day, there's still going to be wildcards. It could be something, and to have one every fourth deal, it could be a little high actually. Like I would say these days, I'd rather have those and
COVID-19.
Yeah.
You never know. Yeah. I like that. The random wildcard. I like it.
Yeah, you can do randomize.
I love it.
It's going to do. Sometimes it's all green. I have a lot of red here.
That's a big red.
Red, the 2x. But yeah, and actually, yeah, I'd like to make it more because one of my second deal actually we did a 4x on, and I just
Wow,
went to three max.
pretty good.
Yeah,
Back in the day, of course.
it was at the time we bought it in 18
Okay.
and we sold it in 22.
Oh, great. It's
So
perfect. Perfect exit.
we were. It's a lot of operators say it's like it was easy to look smart, but it was really a
The
fact of exterior forces at that
Yeah, the
stage.
market was just perfect coming in and perfect going.
For the deals that have been bought around here,
Hmm.
it's slightly different situation. And that would be part of the wild card. You mentioned COVID. COVID at the end of the day,
It wasn't that as bad.
it went on prices, it went faster. It went faster how prices got hot. There was
Mm,
like you don't even see a bump.
no.
Now, from an operation standpoint, it's a different story because we stopped distributions because we didn't know what was going to happen.
Okay.
And for 9 months, there was no transaction.
Ouch.
So I think in reality, it's not a continuous line. There should be a gap of 3 quarters. I guess they just smooth the line. But I
Yeah.
think when it resumed, like it jumped,
Oh.
right?
Do you have a lot of people that were not paying rent? Do you have a lot of problem with collecting throughout that 2020? That with some of these properties
Temporarily, until the government started to hand
help help out the land. Yeah, help out.
assistance to everyone.
Mhm. So yeah, I don't think it
And
was
that's
that
why, and
bad.
that, yeah, and I know one property we did an EIDL loan, which is like a small business. We had like small, the government helped a lot and it helped us like to stay
Keep
on
going.
track.
Yeah.
And then it helped the tenants and so on. It wasn't too bad. It wasn't too bad.
Yeah, the government was printing money like crazy, so I guess
Yeah.
it was a good thing for everyone, I guess, at the moment. But it changed the market too, in which it was just too hot after that. So there was just too much money.
Yeah. Yeah, I know. And that's, yeah, it's, I think you and I, Adriana, were part of a generation where we are not going to be able to benefit of all the social nets that are out there, social security and Medicaid and that kind of stuff, which is, in France, like the same, even more actually. In America, there is some, but it's all based on a system where there was many more people who could put money
Hmm.
in the system
Custody,
than
yeah,
taking out.
yeah,
And now the pyramid of ages, I remember that when we are studying, it's
turn
upside down.
around.
Yeah. You have more people retiring than people working. So
Yep,
it's going to be, that's why
we have to
I think
save.
you have to invest.
Yeah, we
That's
have
the
the
wrong
money.
chart. Where's the other chart that I showed you guys? Yeah.
Well,
That's why you have to think about this. It's like you have to.
exactly. What
You
scares
have
me, one of the things that scares me the most is the health insurance. The insane,
that that's
the
part. I have a former colleague who is retired now and he keeps calling me. They're looking for that you have to go on a list for assisted living.
yes,
And it costs a fortune,
yes,
and actually it's French, so I said maybe you should move to back to France, it will be less expensive. But
probably.
yeah, in America it's just so again that you need to have, it's not even, it's like my comment earlier, I'm 50 when I'm 74 here, or 80 years old, and again there will be inflation and that kind of stuff for sure. Can I live with $4 million? I think I would say probably yes.
Maybe you have to obviously not, you probably won't have be able to have the same life that you have now that you will have then. So there's a lot of budgeting that has to happen for sure.
Yeah, yeah.
So
And I
it's
guess
just a lot of money.
if you consider, and I think it's easy math actually, because let's say you have 3% inflation, you want to do something, a fun experiment. What do you do? Power? Yeah. You do power of 1.03, 3% inflation
Mhm.
over 24 years.
Yeah,
No, actually, yeah, it's divided. See.
there you go.
Yeah, so it's worth in today's dollars,
Oh my gosh.
it would be worth about $2 million.
Well, 2 million. Half.
Yeah,
Almost
at
half.
3% per year, I can improve this table actually
Yeah, by doing that.
by doing that. So in 2024 dollars, it would be $2 million.
Mhm.
And you've done 78% average. Again, I think the answer to that, invest more, maybe put it a little more in deals.
Starting, yes, I mean,
I would say, do you want to go beyond 10? Probably not. I know some people who are like in 25 deals. I don't know
well, I
how
heard this
they
other
keep
guy
track.
that, yeah, he said that he's in 66 deals only. How
At
do you,
once, at the same time?
how do you keep up with all that?
Yeah. And what we do in our fund, we would offer, eventually we'll have, so right now we have 5 total. If you work with us, we are under one umbrella, you would receive 1K1 and everything is in the same paperwork, everything. So
Because it's in
even if
one
you have,
fund.
yeah, because it's via our fund. And
Yeah.
you can pick and choose which deal you invest in. It's not a blind fund. You don't
Right.
you don't deal for, you have a bad impression, you're lucky because that's the wild card and it goes to zero. Don't do it. Skip it. Go to the next deals. And eventually, I think we plan to introduce at least 4 per year. And we don't have an end time. But at some point, some of the deals, they will close, obviously. So at any given time, we may have, there would be another table to do. But at any given time, when we will reach our peak, we'll probably have 20 deals at any given time, like available. And you can think too, like you're doing this, maybe you do 100 this year, then 100 next year, and etc. Bye, Brandon. Thank you for coming. So there's there's so many combinations of things that you can do. That's a lot of ideas actually how to improve this chart.
Table. Yeah, it's a pretty good one. I like it. It gives you a better idea.
Thank you. Yeah, and I think it gives a good illustration. Like I will not say who, but I just watched yesterday a video from another operator out there, and they tried to make I forgot the term in English. To illustrate a concept, right? So they wanted to illustrate the concept of investing in a fund with pizzas. And it was so confusing.
Pizza, really?
Yeah, pizzas. It was
Like
like, oh yeah,
franchises?
so you have so many people and then you buy another pizza and there's another taste of pizza. And I'm like, what the? It didn't make any sense. I
That's
couldn't
insane.
anything else. But
Thank you,
yes, you
thank you
can
for that.
take a picture, use our QR code if you want to reach out. No, that's our email address, our YouTube channel, YouTube at Boost My Capital is our channel. Our website is boostmycapital.com. Until next time, thank you everyone for joining. Unless there's a last minute question. Otherwise, we'll wrap up and I will see you next time.
Bye, Philippe. Thank you.
Bye,
Bye-bye.
Joanna. Bye, everyone. Bye, Denise.
Thank
Bye,
you.
Ethan.
Bye-bye.
Bye-bye.